Options are contracts that give you the right to buy or sell a stock. Let us break down how calls and puts work. An option is simply a legal contract. It represents the right, but not the obligation, to trade shares at a specific price. Most standard options contracts control exactly 100 shares of the underlying stock, making them a powerful tool for managing market exposure. A call is a bet on rising prices, while a put is typically used to protect against falling prices or to bet against a stock. Investors choose calls when they expect growth and puts when they are concerned about potential declines or want to hedge their portfolio. The price of the option, or premium, depends on the strike price, the time remaining until expiration, and how volatile the stock is known to be. Always remember that options have an expiration date. Unlike stocks, you can lose your entire investment if the market does not move as expected. Options carry significant risk. Please research thoroughly before trading. Thanks for watching and subscribe for more finance basics.